Welcome to the Three Edge Week in Review for the week of June 14th, 2021. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing the implications from this week's much anticipated FOMC meeting, where, at least as far as the markets are concerned, the Fed seems to have pivoted by indicating that thanks to the successful rollout of vaccines and the commensurate pickup in economic growth, they now see the possibility of raising short-term interest rates in 2023 instead of 2024. Before we get into that, a brief market update. The announcement issued by the Fed was interpreted by investors to be surprisingly hawkish, ignited selling across the equity markets during the second half of the week. Then, later in the week, St. Louis Fed President James Bullard said the Fed had started discussing scaling back the pace of pandemic bond buying and that this could occur as soon as next year. So, Steve, obviously, anytime markets have a few days of decline similar to what we have seen following the announcement from the FOMC, it can be unsettling. And so maybe this is a good time to take a step back and seek to put things into perspective. So during the week, the FOMC, even though the Fed did not raise short-term interest rates, they didn't roll back their $120 billion in bond buying each month. The announcement this week that they have changed their outlook somewhat and now expect to begin to raise short-term interest rates in 2023 instead of 2024 certainly seems to have spooked the global markets, at least for now. So what does this mean, if anything, and what should investors do, if anything, based on this shift in the Fed's outlook? Is the Fed preparing markets for a more hawkish approach to monetary policy from here and eventual tapering?
So, in their announcement, the Fed admitted that inflation was accelerating faster than they expected. So that was quite an admission. However, what the Fed tried to do was to dampen inflationary expectations with their words, not with their actions. So as you mentioned, they're still printing $120 billion worth of reserves out of thin air. They're still keeping interest rates at virtually zero. And there's no specific timetable when any of that will change. So their actions will still continue to fuel the economy, and that can keep inflation moving. But their words are being picked up by the market as a change in message. And so the markets do take that seriously, and we have seen that reaction.
Excellent. So it also does appear that, we had the changes in equities, we had the changes in fixed income, but there also seems to have been a bit of maybe a mini taper tantrum in real assets, such as commodities and gold. Could you explain that reaction in real assets to this week's announcement from the FOMC?
So now that the Fed has changed its message, and they're now admitting that it's talking about reducing its money printing, rather than putting that off and saying they're not even thinking about it. It puts the Fed ahead of the other major central banks, like the European Central Bank and the Bank of Japan, who are not in any way talking about any kind of rate hikes or tapering, et cetera. So because of that, the dollar has had a sudden jolt. The Fed is controlling the money supply in the U.S., and the dollar has really responded in a positive way. Also, investors have been so negative about the dollar that there was a lot of short covering. So it remains to be seen if this is just a sudden rebound in the dollar after having fallen, and it won't be that long lasting. But while it continues, it's been, at least in the short term, a knock on real assets, because real assets like commodities and gold are priced in terms of US dollars. So whenever there's a sharp spike in the dollar, you get an initial hit in gold and in commodities. So we did see that in the market, and I would call it a bit of a taper tantrum that, unlike in the past that hit stocks more hard, it hit the commodities and real assets. But this could be short-lived.
Excellent. So to me, another interesting aspect of all of this is that 2023 seems like a heck of a long way off, and who knows what the economy will be like 18 months from now. I mean, we seem to be in the midst of an economic rebound from the pandemic, but it's not clear how long that bounce back will last. So could we find ourselves in a position in the future where perhaps there is some inflationary pressure because maybe wages have risen, employers not being able to fill open positions, and just when the Fed feels the need to tighten and raise interest rates to control inflation, the economy at that point may be slowing. Maybe the growth is, has run its course. So, what do you think about this question in this scenario? Is that something that we could see?
Fritz, I do think it's something we could see. And history has shown us that there are periods, we call them stagflation, where you can have rising inflation at the same time that growth stalls out. They don't have to go hand in hand. We know that from the past, and it could happen again. And right now, even though the Fed has sent its message in the recent meeting, it is still enacting extraordinary stimulus. It's still printing money every month. Interest rates are still at zero. This continues to fuel the real economy. And this could lead to stickier inflation numbers that persist. Now, they've managed to convince the markets this week not to worry, that they will have inflation in control because they have the tools. And although they're not discussing and they don't even know exactly when they'll apply those tools, someday off in the future, they mentioned 2023. Well, it could be that by the time they get to that point, growth may have already run its course and have already started to slow. And they may be reluctant to use those inflation fighting tools. Or we know that every time since the financial crisis 2008 that they did try to tighten or did try to lessen the QE, quantitative easing, the money printing, every time they ended up prematurely aborting that mission, because every time they did it, the market took a big hit. Economists projected slower growth, and they didn't want to take that pain and they didn't want to risk it. So they ended up aborting the mission. So it is possible that inflation continues to tick up from here, that people for a while are convinced with the credibility of the Fed, but when it's time to do it, they might either be hesitant to do it or they might start doing it, cause a market correction, and then pull off. So we could see stagflation in the future.
Can I ask you just a quick follow-up question? I think it'd be helpful. So if you look back at this week, and what would you say are your one or two or even three takeaways for investors who looked at what happened this week, and what would you have them take away from what we've seen? Again, to sort of put it in perspective.
Well, number one, the Fed is trying to send a message. It is trying to, as softly as possible, to not repeat past periods of taper tantrums. It is trying to let the air out of the balloon slowly and put everyone on notice that yes, at least now they're thinking about tightening things, or at least becoming less stimulative. And if they can let the air out more slowly, the market takes a more gradual turn, that maybe it won't be such a big bad thing when they actually do raise rates. But there are a lot of ifs with that. Number one, they continue to stimulate the real economy. That might keep inflation going up. And like I mentioned, there's no guarantee that when the time comes to tighten that they'll actually be able to do it in a sustained way. So I think it's a time to be somewhat cautious. They are trying to send a message. We will be hearing more from the Fed in the next few days and weeks, where they try to refine that message. Commodities, we know, took a big hit when the dollar rose sharply. That might be short-lived. So we're looking to see how sustainable that is. We think it could be short-lived. Commodities have so underperformed for the last decade and more that, and it is true recently, there's a lot of speculation building them up. So yes, there's some profit taking, but we think longer term, there's still more room for commodities and real assets to rise. And right now we have to look at long-term bond yields. The extent to which they start to go up would maybe favor the value equities. The extent to which they stay well behaved or actually come down, like just at the very end of the week, then that might favor the growth equities.
Excellent. That's really great. Puts everything in perspective. And also now we can look forward to Jackson Hole and that conference, right, which is in August, where there are a lot of white papers and the Fed will have a chance to fine tune their message at that point. But thank you very much for putting that in perspective for us. So that'll do it for us. But we'll be back next week with another edition of the 3 Edge Week in Review. Remember, all of our videos are available on our 3 Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.